When it comes to building up a monster dividend portfolio, there are two things that really make a difference. Number one, something that pays monthly, and number two, something that pays a really large yield. And in this video, we're going to discuss a stock which has a 13% dividend yield annually and has made consistent monthly payments for years. The stock in this case, AGNC. At first glance, AGNC can look to be having really poor performance, down 36% in the past 3 years. But if we actually look at its 1 year performance to date, it's up 25.28% in the past year. And not only that, when we delve into its stats even further, we can see that it has a current dividend yield of 14.14%. So a 1 year return of 25.28% so far, and a dividend yield of 14.14%, which is simply too good to turn down in my opinion. Dividend is paid monthly, and looking at the financial history, we can actually see that AGNC has paid 12 cents a month per share held right back until March 2020, where the dividend was 16 cents. So typically a dividend cut would be seen as a negative outlook for a stock, but I'm about to talk through some reasons why this may not be so bad for AGNC. The AGNC is what's called a real estate investment trust, or REIT, and so these companies typically hold real estate or real estate related securities, and from there generate large amounts of income. Now what's interesting here is AGNC is actually required to pay 90% of its taxable income back in the form of dividends to shareholders. So you've got a business here whose whole purpose is solely to pay dividends really, but where they actually make their money is interesting. So AGNC don't actually own any properties. What they do is buy mortgage-backed securities. So what happens in this case is lenders or banks get together and pool together companies or individuals who want to buy mortgage products, and then it's called securitization. So they put this into a security and then AGNC basically buy the security. Now, for those of you who were around in 2008 and think this sounds very familiar, you are correct. This is kind of similar to what happened in the subprime crisis. However, there's one big difference here, and this is why I think it's quite interesting for AGNC, is AGNC only buy ones that are government backed. So in essence, what AGNC do is short-term loan to take advantage of interest rates, and then buy these mortgage-backed securities, which are also covered by the government in their case. So they are not completely removed from credit risk, but certainly reduced in the amount of credit risk they're exposed to, while trying to take advantage of the interest rate benefit. Now again, for those of you who have been watching over the last few years and realize how everything's got so expensive and that interest rates have been going up and up and up, this is actually probably the worst time in history for AGNC. So we've seen there that their dividend was cut in 2020, March 2020, which followed COVID. COVID being one of the worst things that put in terms of the rental market in America, buying in America, and of course that was the start of what actually led into the interest rate increases we've seen coming through to current day. So why is this important? Well, actually, for the first time in several years, the Fed in the United States have actually cut interest rates. And so what this means is that AGNC, who have just went through the most difficult time for a company in this industry working off mortgage-backed securities, are now looking at increased profitability. So the interest rate's going down, the value that they get across their investments is going up because they're borrowing at a lower rate and they're still gaining the interest payments and principal back from these mortgage-backed securities, which means I think we're going to see an increased profitability in AGNC going forward. So that up 25% a year could be an ongoing trend. And alongside this, this makes me feel like this dividend is actually safer than it even was previously. The fact that they've come through the most difficult time here means that it's likely to be easier for them to pay. They never didn't pay at any stage through the last 4 years. As long as that has been, it's a very tough period for someone trying to work in this kind of industry for 4 years, but they kept a consistent payment of 12 cents a month. So for that reason, I think it's actually going to get even better for AGNC, and as a result of this, I've been adding more to my portfolio. 13% a month, or a year, sorry, paid monthly has a serious compounding effect, and I actually think this could be one of the strongest dividend stocks to add to your portfolio currently. Obviously this could change over time, But right now what I'm going to do is continue adding to this and see how it works out. So it's a 13% to 14% annual payer, and it'll be something that I think could really supercharge your returns in the portfolio. If there's any other stocks you'd like to see me get a deep dive into, I'm currently working on an extremely high dividend paying portfolio to see how it competes with AI growth stocks, which I have also invested in and know quite heavily from my work. So leave a comment down below, let me know what you think of AGNC, guys, or if there's any other high paying monthly stocks you'd like me to review or think I should be aware of for my own portfolio, let me know.